Hello again. This is your introduction to class preparation assignment number 9. There's a lot of content in this CPA, so there's a lot of slides to try to assist you in understanding it as greatly as possible. First, I'd like to review some things from CPA 7. Bill Bernstein wrote about 4 major risks for investors, inflation being one of them, economic depression, taxation, basically robs investors' returns, and also some type of financial devastation that's a consequence of military action. And we've had some speculation that perhaps there's others. Terrorism, climate change, major natural disasters, someone mentioned, also COVID-19, obviously very much in our thoughts right now. And I kind of wonder if those are separate or if terrorism might be related to war. Climate change might lead to depression or at least a regional impact of some type. Major natural disasters could lead to economic depression. For example, what if the caldera over Yellowstone exploded and destroyed, a third of the United States? Obviously, it could lead to some Great Depression. And of course, COVID-19 is leading to an economic depression, the likes of which we haven't seen since the Great Depression. Let's get into CPA 9 now. Target rebalancing is probably better than periodic rebalancing. Periodic rebalancing is where you uh, get and you say, okay, when, like once a quarter or once a year, I'm going to rebalance my portfolio. And a lot of studies have shown that that's actually a really good way of doing rebalancing. What is not a really good way is doing it very frequently, such as every day, every week, or even every month. Um, but another way of doing rebalancing is when you hit a target to go ahead and rebalance. For example, if you are 20% US large cap stocks and it says rebalance when you're at 20% below that or 20% above that, so it's 16 to 24%, that whenever you hit that target, you rebalance the next day, essentially. Uh, to do that, basically, you have to monitor your portfolio a lot. But financial advisors use software for that. And this is a really effective way of rebalancing. One of those software programs is Tamarack Trading. The fees for this, by the way, cost at least $10,000 a year and higher, depending on the size of the firm and how many accounts you have. Basically, it provides monitoring of the portfolios. It looks, for example, at all of the accounts in one household and see if that group of accounts, all the investments in there, meet their target asset allocation or vary too much. And it also looks for accounts that might hold too much cash or too little cash. A lot of advisors like to hold cash in portfolios as part of an asset allocation. I don't necessarily do that, but I do have clients where we set up a cash because they feel either comfortable with holding 2 or 3% in cash, or we might hold just 1% in cash just to help pay my fees, for example, or a little bit more to fund their withdrawals every a month that are set up on an automatic basis. Also, and we'll talk about harvesting capital gains and losses. Harvesting capital losses really being the key there. When you have capital losses, you can offset capital gains with them. And looking for those capital losses in taxable accounts is very important to do and harvest it when it's appropriate. So this particular software cuts the time we spend on rebalancing portfolios by more than half, even 75%. When I started as an investment advisor almost 20 years ago, all of this was done manually. We would actually go in and look at every account. Now, we had software that allowed us to look and see what accounts were out of balance, but we couldn't automatically rebalance. We couldn't just say, here are the accounts that are out of balance. We had to look at every one. And then we had to plan out the trades and then enter the trades through our trading software with the custodians such as TD Ameritrade, Fidelity, or Vanguard. Nowadays, all you got to do is press a button. It tells you all the accounts, and it also suggests all the trades to be made. and you just click each one and that you approve, and you go from there. Yeah. So let's talk about uh, this chart again. All right. If we have U.S. large company stocks and they are 10% of the portfolio, and the expected return of large company stocks is 6%, then we have to first set up our lower limits for rebalancing. Basically, to do that, strategic asset allocation target 10% times 0.8 is equal to 8%. And 10% times 1.2 is our upper limit for rebalancing, which becomes 12%. And then the contribution to the portfolio's gross return is simply B times C. We convert one of those to a decimal. So, for example, 10% is 0.1. Multiply it times the expected return, and we get 0.6. And we can do that for all the way down, and we can see the results of that. So you can see that the rebalancing for each of those asset classes is plus or minus 20%. Again, it's very easy to do that. Strategic asset allocation times 0.8 for the lower limit times 0.12 for the upper limit, and then the contribution to the portfolio's returns. And on the exam, you'll be able to use a calculator for this, just either a financial calculator or the calculator on your smartphone to do these small arithmetic calculations here. Fixed income investments. Now, I was taught, and this actually comes from Larry Swedroe, that whenever you have a fixed income allocation, you want to set it probably a little bit more narrowly. Most of the, if you have, especially if you have like a 50-50 allocation. So if you have 50% fixed income, plus or minus 20% means you're going to rebalance only when you get to 40% or 60%. Larry Swedroe takes a different approach on fixed income. He basically says, just go minus 5% from whatever your fixed income target is, or plus 5% for that fixed income target. And that's assuming you group all of the fixed income investments together. So here at the bottom, you can use either way. You can either go 0.8 and 1.2, or you can just subtract 20 minus 5 equals 15, 20 plus 5 equals 25%. Either way is fine. Either way works on the exam. And of course, you add all that up on the right hand side, you come up with the gross return of the portfolio, and there's some other things down there. So in this CPA, we're going to explore stock fund fees and cost, and then we're going to explore taxes. Yeah. So why do fees and costs matter? Well, basically, mutual fund fees significantly predict the returns of mutual funds relative to each other. If you have two mutual funds, you're investing in the same asset class, like U.S. large company stocks, over a long period of time, and when I'm saying long, maybe a year, maybe 5 years, or certainly 10 years, the higher cost fund is going to have a tendency to underperform. And what's surprising is a lot of investors don't know that. A lot of investors think, hey, something's higher fee, higher cost, it must be better because it's more expensive. And that's the exact opposite in the world of investing. Also, stock funds and bond funds have to buy and sell securities. So in a stock fund, you're buying and selling stocks a lot. Every time you trade, there's a cost to that. You might say, well, wait a minute, you can trade stocks. There's no commissions at a lot of institutions right now. You can go to TD Ameritrade and Schwab and other places and not be charged any commission, but there are other costs right now to trading stocks, and we'll explore those today. So here's just a chart that shows, hey, here is we'll just go to the right side, the 15-year, over a 15-year period, the funds, the stock funds that had low expenses, only 24 of them, all right, 30% of those funds outperformed the benchmark, all right, and 70% underperformed. The higher cost funds, only 10% of them outperformed. So you see a definite relation, even in a 5-year period here, of between cost and the whether or not they're going to beat their benchmark. Again, most actively managed funds don't beat their benchmark because of fees and cost. There are costs that the investor can easily see. One is a sales load or commission, a contingent deferred surrender charge, which some people call a back-end commission, but it's actually paid up front. I'll explain that. Redemption fees. Uh, for example, if you invest in an emerging markets fund, the cost to trade emerging market stocks is pretty high. Mutual funds in the emerging markets, some of them don't like investors to put their money in 1 month and pull it out the next. So sometimes they'll say, if you sell the shares of your fund within 90 days, we're going to charge you 1%. Because if you pull out your money, uh, and other people do, then we have to sell emerging market stocks, and there's a cost of selling there. You'll see that mainly in emerging markets funds, but sometimes in other funds as well. And then there's this thing called the annual expense ratio, which really comprises three parts: the management fees, administrative fees or expenses, and 12B1 fees. We'll study all of these. Sales load, basically, when you buy a mutual fund, the maximum sales load that you can be charged under security rules is 5.75%. All right. If you buy more than of a particular fund, or more than all the funds in a fund family, for example, like you're buying Hartford funds or something like that, and they charge commissions. If you buy more than a certain level, you can get what's called a breakpoint discount, as long as you agree to buy, or you actually have bought within a 13-month period of time, certain funds. All right, so here's just an example of breakpoint discount. Now, breakpoint discounts vary by fund company. But here's an example. If you buy less than $25,000 in a fund, you pay the full commission. If you buy a little bit more than that, 5%, all the way down to $1 million, none. And when you get to this level, a lot of times the fee at that point is basically the commission paid to the broker is 1%. There's usually a redemption fee if you get out within a year. To help compensate the brokers for that. Now, brokers don't necessarily like to see their commissions decline this way. So a lot of times when I review portfolios, and you might have somebody come in with $1 million portfolio, what you'll see is brokers put $20,000 in one fund, $23,000 with another fund company, and $24,000 with another fund company, and all to basically make sure that their commissions stay relatively high. Yeah. If you did pay that 5.575% load, what is the impact of that? How much additional return do you have to pay in order to break even because you paid that commission? If you if the basically the stock fund is designed to earn 10% a year, all right, you have to make some assumptions here, and you hold the fund for only 5 years, then you have to have a fund that's going to outperform by 1.2% just to pay off this sales charge. Of course, most funds aren't going to outperform that much. Even over a 25-year period, you have to outperform by 0.26%. So the impact of commissions is really, really large. 20 years ago, 25 years ago, most mutual funds were sold with these sales loads of some type. Nowadays, most mutual funds have no sales loads, no commissions associated with them. You can buy many mutual funds and exchange traded funds without paying any commission. The interesting thing about this, you remember the 5-year holding period here, 1.2%? Investment Company Institute, which is a trade group for mutual funds, stock mutual funds are held by investors for only 4 years on average, and bonds funds for less than 3 years. Yeah, that's pretty lousy. And of course, if you think back, you know what? If you buy a stock mutual fund or a bond mutual fund, and some time goes by, markets go up and down, you're going to have to rebalance. So you're going to have to buy and sell periodically throughout the years, and that could generate more commissions for the broker. Now, the annual expense ratio of a fund is an annual charge. It's charged on all funds, but not all of these fees are charged on all funds. There's a management fee. basically who is in charge of managing the investments of that mutual fund. That is actually called an investment advisor. So these are also called investment advisory fees paid to the investment advisor of the fund. For example, if you're working at Vanguard, uh, you could be an investment advisor to several different funds working for Vanguard. You have stock analysts working for you if you're working the actively managed funds. You have an investment advisor who basically makes the final decision for that fund, maybe several other funds as well. And it's a few Vanguard funds actually outsource the investment management, the investment advice to a separate company. Wellington Investment Group uh, is the outsource provider for the Vanguard Windsor funds, one of the big and oldest of the Vanguard funds. But most of the time, management fees basically are paid to the fund company to its affiliate that acts as an investment advisor. Then you have administrative fees. These are fees that are designed to um, basically pay for things like printing the prospectus, filing. There's a quarterly filings with the SEC. There's a registration fee with the SEC. There's legal fees. There's printing costs. There's mailing costs. All of the things that basically keep the fund operating and communicating to all of the people out there. And then there's a 12B1 fee. It's very controversial, although it's been around for over 30 years, probably almost going on 40 years at this point. And it's very common, although there's a lot of funds without it. Um, and that basically, it's a fee that was put in place to basically encourage brokers to sell mutual funds back in the early 1980s, when mutual funds are having a hard time struggling to survive. This fee was put in place. It can be as much as 1% a year. So that fee can be quite large, and most of the fee it's collected by the mutual fund company, but it's paid to brokers. I call it an investment advisory fee and drag in essence, because that's really what it pays for. Uh, the annual expense ratio, excuse me, I'm not catching COVID-19 now, uh, because I have sheltered in place. The annual expense ratio has been going down. This study showed that the all funds it went down to 0.64% from 0.7% back in 2000. Um, and we have other studies. Morningstar has done. U.S. stock funds fees declined from 0.79% for actively managed stock funds. This is the annual expense ratio, down to 0.7%. Now, this does not include commissions. This does not include the sales load. That's something different. For passively managed funds, which are mostly index funds, 0.13% has declined to 0.1%. And in 2009, we saw some more declines in fees, but we haven't accumulated all the data as of yet. Here's just another chart showing that mutual fund fees for actively funds have gone down, and passive funds, the fees have gone down as well. Basically, over the last decade or two, there has been a upsurge in the number of investment advisors who represent clients, and we also have more sales of mutual funds through the internet without sales loads, and we have a rise to basically this recognition that index funds tend to outperform actively managed funds because of the higher fees and costs. And all of this is contributing to a more competitive environment for mutual funds that is forcing them to lower their fees. What companies sell the most funds? Well, here's a 2014, at the end of 2014, they looked at this from a standpoint of market share. Vanguard had 19.2% of the market, Fidelity about half that, American Funds, which is a brokerage sold, uh, primarily brokerage sold fund company, fairly expensive mutual funds. BlackRock iShares, which was fairly new at the time, it actually resulted from some mergers that took place and a spinoff that took place. Then we have others as well, including one of my favorite fund companies, if not my favorite, which is Dimensional Funds Advisors. So, here we go, which only had a 1.7% market share. You can see some of the fees here. Uh, the average expense ratio 0.87 for Franklin Templeton, 0.71 for American funds. Fidelity is much higher fees than Vanguard was. T. Rowe Price fairly high, and PIMCO, which is a big bond fund shop primarily. Uh, and then we go forward. As of October 31st of 2019, we look at the market share. Vanguard is much more than, it's 2.5 times the size of Fidelity. American funds hanging in there. BlackRock has come over into fourth place. Fifth, sixth, seventh, eighth is now Dimensional Funds, 431 billion under management. This is 5 trillion under management. So these are the big fund companies. And if we go and look at the amount of money that has come into the fund as of June 30th of last year, Vanguard is pulling in more money, followed by BlackRock, which has got a lot of low-cost exchange-traded funds called iShares. Fidelity is still pulling in money primarily through the 401k plans that it provides. Schwab, which is a discount broker, it started having its own funds, and Dimensional is up there as well. And what you see in terms of expensive funds, JP Morgan's still down here, Morgan Stanley, those are big brokerage firms that also sell their own proprietary funds. But what you don't see on there anymore is American funds and Franklin Templeton, I don't believe. Yeah, those high cost fund families have lost market share. Uh, Now, fees do vary by the type of fund you're looking at. Large company stock funds typically have lower expenses than small company stock funds. Emerging markets funds have higher fees and cost. And bond funds typically have lower fees and cost. High yield bond funds a little bit higher. And then you have emerging markets debt funds, which have high fees, and I recommend you stay away from those. Very risky. So again, the fund management fees are paid to the fund's investment advisor, the manager. Usually it's an investment advisor who is actually hired by, for example, Vanguard or Fidelity, but it could be a separate management, a completely separate and independent investment advisor. A lot of times, part of the management fees that you see are actually paid back to the brokerage firms in an arrangement called payment for shelf space. Usually it's only like 10 basis points or 15 basis points a year, but it's basically to encourage broker dealers to uh, sell that fund and push that fund over other funds. Administrative expenses are often paid to affiliated companies, basically a subsidiary of some type. All right. They tend to be higher with bank trust departments. Bank trust departments will have at banks they'll have their own proprietary funds, and there are state statutes that basically say you have to rebate the management fees so you're not double dipping when you're serving as a trustee. A bank trust department serving as a trustee, but the state statutes don't force the refund of administration fees of a fund, and the result is they tend to be quite high relative to other funds. Then you have this 12B1 fee. 80% or more of these 12B1 fees are paid back to the brokerage firms. Um, so those are kind of disclosed costs. We have a lot of hidden costs. A lot of hidden costs relating from trading as well. Some of those you can pretty much observe in the marketplace. Others are very hard to see. They're kind of below the surface. All right. So things that we can see are brokerage commissions. We can actually see how much mutual funds pay for brokers to buy and sell, the commissions that are paid. We can find that in the annual report of a fund. Sometimes funds will pay brokerage firms higher commission rates than they normally have to in return for research that is used by the fund company. Um, those are called soft dollar payments. It's permitted by a statute. I'm a big I don't like that at all. I think a lot of the research never goes used. It's basically just another way of getting money to brokers from mutual fund companies that creates another conflict of interest. There are some taxes that have to be paid. If you are a U.S. stock fund and you're investing in stocks held in other countries you have to pay taxes on, for example, dividends or capital gains. And that could hold down the return of the fund. It could also lead to tax credits, which we'll get into later. There's also actually a positive. If you're running a fund that's very broadly diversified and doesn't do a lot of trading, you can actually loan out the stocks in the fund to a broker-dealer firm who then loans them out to clients for the purpose of shorting stocks. You have to actually own a stock to short it. And when you loan out the securities, you actually get cash that you can invest. The cash invested earns interest, and that can result in what's called securities lending revenue, which can be a small addition to the returns of a fund. But then there's all these other costs here: bid-ask spreads, market costs, opportunity costs due to delayed or canceled trade, and opportunity costs due to cash holdings. All right. So again, brokerage commissions, how do we find them? We can actually go to the fund's annual report. We can look for state assets. We can also look at the fund's statement of additional information. There's a prospectus for a fund, but then there's a whole bunch of further detail that the SEC said most investors don't really want to know all this detail. We'll allow it to just be put into another document called Statement of Additional Information. Yeah, and there's a way of computing the brokerage commissions. Basically, you don't need to know this, but how to do this, but it's something that I do. I'll go in and figure out what is the impact of commissions. And most of the time nowadays, commissions are pretty low. The impact might be 0.03%. I still see some like 10 basis points impacts at times when funds do a lot of trading. Here's an example from 2014. One of the biggest brokerage sold mutual funds in the United States, Growth Fund of America. I pulled up the brokerage commissions. I looked at the net assets, and then I did a calculation, and I came up with 3 basis points is basically the impact of the commissions that were paid by that fund. And here's a disclosure that's found in the Statement of Additional Information. It basically says, the investment advisor, the fund, may execute portfolio transactions with brokers, all right, who provide brokerage or research services to it, all right. And then somewhere in here, it basically says that the fund saves costs because it gets research, but it spends more money on commissions. Either way, I think that's kind of a way of hiding some of the cost of investing, because that cost is not reflected in the annual expense ratio. Whenever you buy and sell a stock, there's usually something called a bid-ask spread. So we consider a stock that's trading at $9.95 and $10. That's called a bid-ask spread. All right, we have a bid price and we have an offer price. So a seller is offering to sell for 10, and a buyer is offering to buy for $9.95. And the bid-ask spread is only 5 cents. But 5 cents divided by $10 per share is 0.5%. That's 50 basis points. So anytime you trade a stock, you're going to have a bid-ask spread. And I'll tell you what, well, let me just pull it up real quick, here. We'll go to Yahoo Finance, and we'll just pull up. Everybody's on the internet today. Yep. We go to Yahoo Finance, and we'll put in the name of a company, and I'll put in Dollar General. DG, okay? And we'll look here and we'll say, what is the bid and ask spread here? It's only 3 cents out of 169, so a really low bid ask spread, and that's typically what you'll see for larger companies, and this is a mid-sized company. If we go to First National Bank First Corporation, we'll go to First National Corporation. That's traded. I'm trying to find something that's traded not on the New York Stock Exchange. We'll go here and look at their bid-ask spread, and it's quite high. Wow, that's 67.67 or 67 cents, and that's like a 4% Uh, the volume here is only 20,000 shares as of today, and it's about 3 o'clock Eastern time in the afternoon. So whenever you have small companies, they tend to have really big bid-ask spreads, and it becomes very difficult to trade small companies without incurring some really huge cost. So trading, basically, bid-ask spreads have actually come down quite a bit over the last couple of decades. Uh, they are much less than they used to be, uh, but they still exist. And basically, to try to avoid bid-ask spreads, uh, you have to basically not trade as much. For the largest 250 stocks in the United States, the bid-ask spread is typically only 1 basis point. So if you're trading Apple or General Electric, ExxonMobil, some of the other big companies out there, you're not going to be charged a very big bid-ask spread. But again, mid-cap and small-cap stocks, you're typically going to get pretty high bid-ask spreads. You have to be very careful when you trade. All right. And here's just a chart that illustrates that bid-ask spreads have been coming down. This is since, and this is New York Stock Exchange listed, has come down further than NASDAQ listed. And the bid-ask spreads, by the way, that's why you see free commissions. Because with those bid-ask spread, any broker representing a buyer or seller gets part of that difference. And that's called payment for order flow. Mutual funds have a much bigger problem. It's called market impact cost. Basically, if you're a large fund, if you're a fund that has 100 billion under management, and that's not unusual to have at least 100 billion. Some funds are much more bigger than that. And let's say you have 200 stocks in your fund. On average, each holding is $500 million. If you want to sell if your portfolio manager says we don't want to own this stock anymore, the traders have to figure out how are we going to sell $500 million worth of stock, because the stock market is basically, the exchanges or whatever are basically double auction markets, and they're weigh mechanisms, supply and demand. So you put a lot more supply out there of a particular stock, it's going to force the price down. So whenever you see very large funds, or when you have multiple funds but they are an index fund and they're tracking the same index, basically the index changes sometimes yearly, sometimes twice a year, and all of these funds have to buy and sell the same stock at the same time when all tracking the same index. Market impact costs can be greater the more trading that you do, and if you have funds with concentrated security holdings. All right. So these index funds can actually incur pretty meaningful transaction costs, because basically an index has to publicly announce here are the stocks that are going to be added or dropped from the index. And everybody gets all that information all at the same time. And the result is it impacts the price of the stock very quickly. Uh, the the oldest index that has been tracked that tracks U.S. small cap stocks is the Russell 2000, and its returns are really low. And the reason for that is there's about 12 different funds, fairly big in size, most of them, that track this index. And because of that, there's a huge market impact cost. There's some other reasons behind the fact that the annualized return over a fairly long period was pretty low, but the biggest one is probably market impact cost. Now, there are other transaction costs. One is if a trader says, I don't want to sell $500 million worth of stock all at one time, maybe this stock is only trading 10 million or 50 million per day. If I put $500 million worth of stock out there for sale, it's going to force the price way down. What they'll do is they'll trade that stock through multiple brokerage firms over a period of time, maybe a week or two, or even longer. Well, if that's the case, then what typically happens is the price is still going to go down, and you're still going to see some impact, not as great an impact as if you put it all out there at once. So basically, sometimes you can put a trade out there. It's called a limit order, and basically the price never falls or rises to that level, and the trade is in essence canceled. So you basically have what's called an opportunity cost here from delayed or canceled trades. You can measure all of these costs. They're called institutional trading costs. There are actually firms that go out there and measure this. Back in 2010, 2012, they measured this. U.S. small cap stocks, the average mutual fund had 120 basis points in terms of the cost there. U.S. large cap stocks, the total trading cost, including market impact and bid-ask spreads and commissions, were down here less than 40 basis points. Emerging markets, transaction costs tend to be a little bit higher. Here's mid-cap. Here's United Kingdom, fairly low, but United Kingdom also has some taxes that it applies. And here's developed markets in Europe, pretty low trading cost relative to the United States. And a large part of that is because here in the United States we permit payment for order flow. We permit brokers to trade stocks to receive part of that bid-ask spread. Um, Portfolio turnover is a way that we can look at a fund and try to say how much do they trade. Uh, the SEC unfortunately allows the lower a purchaser's sales of the stocks in a fund to be used to compute the portfolio instead of the average. So sometimes you'll see a relatively new fund that's just buying securities. It's all getting new cash and it hasn't sold anything. It can actually report a zero turnover because it's using the lower of purchases or sales. It hasn't sold anything, zero. Even though it's been buying a lot, it's said to have a zero turnover when in fact in the first year of a fund, even if it did no selling, turnover would be computed at 50% under a better formula. So basically, anytime I do a due diligence analysis on a fund, I go in and to the data and figure out my own portfolio turnover ratio. Sometimes it's pretty close to the other ones, but other times it can be quite different, especially if there's been a lot of cash moving in and out of that fund. So this is just the method I use. You don't need to know that. But here's another key cost. As of 2014, U.S. actively managed stock funds held 3.6% in cash. Well, that cash is invested in just earning interest, which nowadays is pretty low. And instead, it's not earning what you would think in a stock fund. So stocks might earn 8, 9, 10% or more on average over years. So there's a difference there in what that cash is earning. And if you basically you take the expected return you would get on stocks minus the expected rate of return on cash holdings, you multiply that times the percentage of cash holdings. And again, you do not need to know this formula. I'm not going to test you on it. But basically, you would see that 3.6% cash holdings translates for a stock fund. And that's assuming a 4% cash return, which you don't get in today's market by any means. 21.6 basis points per year. That's just another cost that drags down the return of funds. It's called a cash drag. So transaction cost disclosure, I think, are pretty weak here in the United States. I think they are likely to be mandated. Canada's actually got better transaction cost disclosures on Canadian funds than the United States does at this point. So at some point, I think we're going to see some changes there. What's the best way to control all of these transaction funds? Basically have funds that do very little trading. They don't track a particular index. They're not forced to buy and sell as that index changes. They are established in size. A lot of times I'll see a fund, I say, hey, I really like this new fund out there. I like the asset class it's investing in. Its annual expense ratio is low, but I'm going to wait 2 or 3 years for other investors to get in there, because at that point the amount of trading relative to the amount of assets becomes much lower. So I'll wait for 2 or 3 years. I won't typically invest my clients in any new funds right off the bat. And you also look for investors who look for funds where investors don't pull money in and out very frequently. Most retail funds, they do, yeah. And you also look for funds that have very low cash holdings. So, stock mutual funds, hey, they offer a lot. Diversify, my favorite word, right? But they do it at lower cost? Well, sometimes. they do have professional trading there. There are ways of trading stocks where you can actually cut all of these transaction costs down fairly significantly through patient trading, and there's some other techniques that are out there. But you really have to be careful when you choose funds to keep all of these hidden costs from dragging down the return of investors. I think probably a decade from now, because of the lower cost of trading individual stocks, and because of better computer technology, we'll probably see small investors be able to basically diversify our portfolio, own 3,000 US stocks, even if you only have like $50,000 in your account, because basically investment advisors working with brokerage firms will design it where you can actually own all of these stocks individually, as opposed to holding them through mutual funds. There are some programs out there right now that do that. They're mostly for higher net worth investors, or the ones that are going to lower net worth investors don't offer enough diversification yet. But this is happening, and maybe stock mutual funds will be a lot less desired a decade from now, as opposed to these other programs. And again, individual stock programs probably going to be coming along, and something to look for. Not in your 401k though, they'll stick with mutual funds for quite a while. Now there are some other types of funds out there, exchange traded funds and unit investment trust. All right. Mutual funds, there's actually different types of mutual funds. Basically, again, you're pulling in your money with money from other investors. It's mutually, you give it to an investment advisor, they invest the money for you. And they offer these benefits: diversification, lower trading costs relative to individual investors some of the time. Probably in the bond market, you get a lot less trading cost there, because when you go out and buy and sell bonds in $1 million increments and $5 million increments, like mutual funds typically will do, bond mutual funds will do, the commissions, the what's called a principal markup and markdown is really low. Another advantage of a mutual fund is you can buy and sell it any day, and if you believe in active management, you can choose an active manager, a professional manager, to manage your money for you. But they have all these fees and costs. A lot of them have high annual expense ratios. Some of them have those sales loads or commissions. Some of them have very high transaction cost. And so you basically, a lot of due diligence is needed to figure out how much is this fund really costing me. And even then, a lot of times you can only come up with an estimate. Now, one type of mutual fund is called an open-end mutual fund, and this is the typical mutual fund out there. If you want to go out and buy or sell it, you can enter an order for that. You will only trade at the close of trading. So let's say I have a client who owns $100,000 of a mutual fund, and for rebalancing purposes, I want to sell off 10,000 of that. I will enter the order through the brokerage firm to sell that $10,000 of that mutual fund, but that order will not be executed or traded until 4 p.m. At 4 o'clock, the net asset value of the fund, basically the value of the fund shares, which is determined by the value of all of its stocks. Stock prices have gone up and down during the day. That's all computed, and I get to execute that at the net asset value, whatever it is. But if I wanted to trade an open-end mutual fund like at 10 o'clock in the morning, I can't do that. I have to wait until the end of the day for that to be traded. The advantage is I get whatever the net asset value is. I don't have to worry about a lot of commissions or bid-ask spreads or anything like that. So 25 largest mutual funds. SPY, which is a S&P 500 index funds, signals that it's an exchange traded fund or a closed-end fund. And so we do have some very large mutual funds that are actually closed-end funds or exchange traded funds, SPY being one of them. Closed-end funds are a little bit different. All right. There's a finite or just a set number of shares of that fund. So you're not going to be having investors going in and out of that fund and generating a lot of necessary transactions. You can buy and sell the shares throughout the day. When you buy and sell the shares, you could be paying a discount or a premium to whatever the net asset value is. So, and you see this most often in bond funds, but you can also see it in some stock funds. Uh, is there an advantage to that? I think if there's an advantage, it's very limited actually because of the premium and discount that you might have the risk of paying. I don't see a big advantage of closed-end mutual funds. From a standpoint of minimizing market impact cost, the trading that funds have to do, there could be an advantage of that. But you can find very low turnover funds now in the open in mutual fund space as well. Exchange traded funds are very popular. They started out basically they all had to be index funds at the beginning. That is not the case now. They trade throughout the day. All right? You can buy and sell them at like stocks, and unfortunately, you have bid-ask spreads for them. So they can trade at a premium or discount to the fund's net asset value, and most of them, but not all of them, track indexes, and they must report their holdings. Not It's really not a rule that requires this, but it's a practice, and they also don't need to hold cash for redemptions. So trading costs can be minimal, 0% commission, but you have to watch the bid-ask spread. And I just want to take you back over to this, and we'll put in one of my, really the only exchange traded fund that I use in my portfolios is the Amplify Black Swan Growth and Treasury Fund. And we look here and we look at its bid-ask spreads, and we see here it's 15 cents. So that's about 0.5%. And if I want to go out and buy shares of this, a lot of times what I'll do is I'll put in a limit order and I'll say I will accept a price of, for example, 29.24. And I'll try to get whoever's selling shares of this fund to accept a slightly higher bid price. That way it's called trading within the spread. And I try to lower that. I'm not a big fan of paying even 30 basis points for buying a fund, but these are typically long-term holdings. You're not going to buy and sell all out of them very quickly, and that's something you want to do. So this is a rather unique fund that has upside potential but limited downside potential, and it's very interesting fund to use in some portfolios. One of the few funds that I've actually added to my approved list of funds over the last 10 years. So let's go back to our slides. As we can see, there are trading costs for the exchange traded funds. A lot of people say, hey, you're going to trade exchange traded funds. You don't have to pay any commissions, but you got to pay these other costs. And a lot of people are not even aware that these other costs exist. In fact, anytime you buy or sell an exchange traded fund, you want to do that with a limit order. A limit order may cost a little bit, may not be a $0 trade, but what you're doing is you're not allowing somebody to come in and snap it up at a price that's set by the market. Um, Definitely want to avoid the risk of doing that. Exchange traded funds do tend to be more tax efficient. And the reason is that, let's say an exchange traded fund, a lot of people want to sell shares of that. And the exchange traded fund has got to come up with cash to handle those redemptions. What happens is the exchange traded fund will basically transfer those stocks to a brokerage firm or an institution like a pension fund, and have basically, and the pension fund or brokerage firm transfers cash back. So over there at the institution, then all the stocks will be sold, or if it's the reverse, to be bought stocks to basically do that. What they do when they do that is they transfer out the lowest cost basis stock first, which means stocks with the highest capital gains get transferred out, and that makes the fund extremely tax efficient because it's not incurring a lot of capital gains when it's buying and selling stock within the fund. This is kind of a tax loophole. I was talking to Larry Sweater. We were having lunch about a month ago, and we were talking about this and the fact that it was a big loophole in the tax code. And I indicated, yeah, the Congress tried to close this loophole at the end of 2017, but there's a lot of pushback. It's very difficult to close this loophole without affecting individual investors who trade stocks. Um, but I think they need to go back and do it. But right now, exchange traded funds in a taxable account can be more tax efficient than stock mutual funds. Um, there are a lot of benefits of exchange traded funds, and let's just take a 5-minute video to kind of learn more about exchange traded funds, get better insights into them. Come on, internet. All right, you guys, stop playing your games on the internet. Get this one going here. Yes, I do want to watch it now. Now playing. Must be an internet thing. Well, since I'm not having much luck with this, I'm going to let you go and watch that video. It's at CNBC. These slides will be posted. You can pull that up, go watch that. Try to get some more understanding of what exchange traded funds are. All right. And there's another site here from Fidelity. There's 5 short videos about exchange traded funds that can provide you more insights, and I encourage you to look at those as well. There's another type of mutual fund out there. It's called a unit investment trust. Very similar to closed-end funds. Basically, a lot of them are stock funds, and they say, hey, you put your money in here. We're going to buy 30 or 40 stocks and hold that, for example, for 2 years. At the end of 2 years, we're going to sell those stocks and give you a cash back. These are limited duration mutual funds. And to me, they make absolutely no sense at all, because you're forcing, in a taxable account, you're forcing capital gains to be realized at the end of every 2 years. You're also forcing trading costs to occur. Um, so uh, the reason is, why do they exist? Well, the large part of the reason they exist is a lot of them charge 2% commissions. And if you're charging 2% commission, you got a unit investment trust that only lasts for 2 years. Basically, you're averaging out 1% per year just by selling these things. To me, they make absolutely no sense at all, and you should avoid them as an investor. You will not see these in 401k platforms, but you'll see them. Brokers will try to push them sometimes. So just a video here. Be wary of these. This is actually a video, I believe, from a law firm. The sales charges, these commissions happen again and again, and also you have these capital gains. So if you're researching funds, there's a lot of different places to go that you can look at. You can find like a 1 or 2 page fact sheet about the fund. You can find a prospectus. The Securities and Exchange Commission, SEC, allows a summary prospectus, which could be under 10 pages. The statutory prospectus for a fund could be 10 to 30 pages. You have a statement of additional information, which often relates to many different funds in a fund company, and it might be anywhere from 30 to 100 pages. And then you have the annual report of a fund that lists all of the securities held by the fund, semi-annual reports, and tax sheets, basically to identify how much taxable distributions of capital gains, qualified dividends, non-qualified dividends, interest income is going to be paid by a fund. All of these things are usually found at the website of a fund company. All right. And for example, we'll just do a real quick example here. We'll go to dimensional funds. All right. And I'm going to log in as an advisor. I've got access to the client side of this, so I'm just logging in here. And then I'm going to go to the funds here and pull up a list of all the funds. And this is loading. And you see all these different funds here. Could probably sort them by portfolio name. So I'll come down here to what's my favorite fund. I might go with U.S. Small Cap Value. Here we go. This is one of the funds that was one of the first funds that Dimensional formed. The 1 year return, here it is, April 9th, is down 35.36% over the last 12 months as of March 31st. The market has actually gone up quite a bit in the last 9 days. All right. And you can also see the fund return since inception, close to 9%. The expense ratio, which is a little high on this fund, which is the reason I prefer some of their other funds primarily. But I can pull this up, fund, and I can go to it, and it will give me an asset allocation, 100% U.S. stocks. It owns 1,000 different companies that have an average market cap of $1.6 billion. Here's a price to book ratio. It also has a profitability ratio there. It's got fairly low turnover, not tremendously low, but fairly low. It's allocation by sectors, allocation by country. It's all U.S. stocks. And here are the top holdings. Tech Data Corporation. Some of you may have heard of that. Kemper, an insurance company. Washington Federal, probably some type of bank or savings and loan, something like that. And then the performance of the fund, again, calendar year returns, and the distributions that were paid. And then you can go down here to documents. So I could look up and say, I would like to view the summary prospectus of the fund. And we'll let that pull up. And here we have the summary prospectus. And I can go down here. I can see its management fees, 0.48%. Other expenses, those administrative expenses, 0.53. There are no 12B1 fees. Here's the cost to own this fund over a 10-year period of time, assuming that you put in $10,000 in. So 1 year, $52 over 10 years, because of the compounding effective cost, $640. It discusses portfolio turnover, 19% in this case. Again, if I was doing due diligence on this fund, which I periodically do, I would go back in and recompute that myself. And then it goes into the investment strategies, and basically it says value stocks, all right, small cap stocks here, all right, may adjust the representation, including momentum, all right, value, profitability, investment characteristics, and other factors. So it's basically a multi-factor fund, all right, and the like. So this is kind of the prospectus. It goes further. It goes to some disclosures in terms of total returns relative to benchmark. The benchmark in this case is the Russell 2000 Value Index over a 10 period of time. Small cap value portfolio return before taxes has outperformed its benchmark, which is kind of surprising because the last 10 years small cap and value stocks have done worse, and this has got a much more small cap and value tilt. But because of the cost of that, so I can do all of that. I can also go to the statement of additional information for the fund and pull that up. And here you get a whole bunch of, here for example, are brokerage transactions and just a whole bunch of things. Who are the portfolio managers? What is their code of ethics? How do you buy and sell shares of the fund? A lot of things that individual investors don't really need to know. But if you're doing due diligence, I'm looking, for example, at the commissions, the brokerage commissions paid by the portfolios. And here's, for example, a U.S. large company, which is a pretty big fund, paid $64,000 in commissions. Not a lot of commissions, and doesn't look like that's in thousands. And you come down to the small cap value portfolio, it paid over $1 million in funds, and I would compare that to the amount of assets in that fund, which is very, very significant, and try to figure out how much this is costing me as a basis point. Now, Dimensional does not pay soft dollars, so I'd be looking for a soft dollar disclosure, but it's not here. And It also says who are they trading with. All right, and you can see that they're trading with a whole bunch of different brokerage firms in terms of who's executing. And Dimensional doesn't, because it doesn't pay for extra to brokers. You're not going to see listed here typically firms that charge higher trading costs, like the big brokerage firms like uh, Merrill Lynch, which is a subsidiary of Bank of America, Morgan Stanley, J.P. Morgan, and the like. Uh, so And you come down here, you even come down and find out that they use options on indexes basically to make sure they don't hold a lot of cash. And then other disclosures. And way down here, at some point, you'll come down to um, who are the directors of the fund. Here we go. How long have they been a director? How many directors, how many portfolios or funds are they own? And um, or have they been a director of any other publicly traded company? And sometimes you'll see that. All right. So these are basically, if you look at this list here, let's see, who are the directors of this fund? Let's see, Roger Ibbotson, Yale School of Management, very famous in the world of investments, as is Edward Lazier. Myron Scholes, Nobel Prize winner, is on the board of directors. And keep coming down here, David Booth, the founder of Dimensional, one of the co-founders of it. And then we have which of those directors are disinterested and the like. And then we see also how much they get paid, aggregate compensation, and this is from the funds themselves. So you got to find out a lot of information here. Then we find out the officers of the fund. Not that most people need to know all that. Okay, there are also fact sheet. If you were to look at a fund, sometimes you might just pull up a fact sheet for it. It's kind of a nice way of looking at a fund. You can find out a lot about it. How much does this fund have? $14.6 billion in assets. All right. You can look at the principal risk of the funds, the number of holdings, the price to book ratio, annual turnover. All of that is reflected just in this two-page sheet. Where's it allocating? Where are the top 10 holdings again? And what is the fund costing? Now, fact sheets tend to be set up differently for each mutual fund company. I'll close out of there and we'll go back to our slides. And then we get to talk about taxes. So that if you want a little pause, this is a good place to take a pause because we're getting into taxes, and the information here tends to be a little bit tougher in terms of taxing. But we do need to learn about this so that you can become a great investor. There are three types of taxable accounts. One, accounts for tax purposes. One is a taxable account. It's an account you set up. It's not an IRA account. It can be a joint account with a spouse or somebody else. It can be a living trust account. If you have a living trust, which is something used in estate planning. But basically, you pay taxes on any interest, dividends, capital gains that are incurred in that account through those investments every year. Tax deferred accounts are like your 401k, traditional 401k or 403b plan that's used in universities. There are some other types of qualified retirement accounts, a traditional IRA account. And we have tax-free accounts, including Roth IRAs, Roth 401ks, is also Roth 403bs at this point. So those accounts grow tax-free. When you pull the money out, you don't pay any tax on it if you meet certain conditions. Tax-deferred accounts, you don't pay taxes as long as the money's in there. When you pull the money out, you have to pay taxes on it, however. So, first, taxable accounts. Let's say you buy a stock mutual fund at $10 a share. It grows in value to $12 a share by the end of the year, and you still own it. Do you pay any tax? We're going to assume that the mutual fund has no capital gain or dividend distributions, which is pretty rare. But you buy a stock mutual fund, you paid $10 a share for it, it's grown to $12 a share. Do you pay it? You still own it. Do you own it? Do you pay any tax? The answer is no. You don't. That's an unrealized capital gain. Although there's a gain in the amount of of the capital that you put in that fund, it's unrealized, which means that you have not sold the shares of the fund yet. Therefore, you do not have a capital gain. Now, let's say you own the shares of a stock fund for 1 year. You purchased them on June 4th of 2018. You sold them on June 4th of 2019. You own 100 shares. You bought them for $10 a share. You sold them for $12. What's the tax consequence? Is the capital gain realized? Yes. When you sell a stock or a stock mutual fund or a bond mutual fund, you realize the capital gain in it. Is it a short-term gain or a long-term gain? Well, to be a long-term gain, which results in lower rate of income tax, you have to basically own it for a year and a day. And here, you own it for exactly 1 year, not a year and a day or longer. So it becomes a short-term gain. All right. So short-term gain it is. It's a realized capital gain, and it's taxed as ordinary income, which is basically your normal income tax bracket, normal income tax rates. All right. Now, mutual funds, you can own them, not sell them, but you can. The mutual funds are required to pay you dividends, typically on a quarterly basis. Some of those might be qualified dividends, which get taxed at the long-term capital gain rate. Some of those dividends might be non-qualified, and they also pay out capital gain distributions relating to trades of stocks within the funds. Those can be either short-term gains or long-term gains, and those are typically paid out near the end of the fund's year, a lot of times in December. There can also be credits that the fund passes on to you. If the fund owns stocks in overseas countries, and because there's dividends or capital gains, the fund has to pay taxes in those countries, then those taxes can come back and basically give you a tax credit in many cases. That's in a taxable account. Qualified dividends are taxed at lower long-term rates. To be a qualified dividend, they have to be a domestic corporation in which the fund holds it for a period of time, and those are taxed at lower capital gains rate. You don't need to know all the technical details about mutual funds, the holding periods for qualified dividend treatment for mutual funds, or for you, if you were to hold individual stock, you have to hold it for a certain period of time before and after what's called the ex-dividend date, the date in which dividends are declared to be paid. So, or made rather. And you don't need to know all these rules, but realize that if you're investing in a taxable account, either with stock mutual funds or with stocks, individual stocks, you want to try to secure, if you have capital gains, you want to try to, if you have dividends, you want to make sure that qualified dividends, if you have capital gains, you want to try to make sure that they're long-term capital gains. All right. Again, we have foreign tax credits and deductions. And most people will take a tax credit, but there's a limit on that amount of tax credit. It's $600. If you have a huge amount of foreign tax credits, you would take it as a deduction. A credit is a $1 per dollar offset of taxes. A deduction basically just reduces your income, and then you apply your tax rate to it. So here's an example. Say you hold an international stock fund. The stocks in that fund earn $1,000 in dividends, but foreign countries will hold tax and pay $70. The mutual fund company pays $70 to these foreign countries for taxes. So you only receive $930 in dividends. All right. If you hold that in a taxable account and you're in a 25% federal income tax bracket and 70% of those dividends are qualified, then what's reported to you on a 1099 you get at the beginning of every year for the prior year, you get actually reported the full amount of the dividends. You also get a $70 foreign tax credit, and it shows that $700 of the dividends are qualified dividends. All right. So you owe tax on the full $1,000 of dividends, and some of those will be taxed at 15% rate, assuming you're in a fairly high tax bracket, and 25% of the non-qualified dividends if you're in a 25% federal income tax bracket. And there's actually no tax bracket at that level right now, but you could be in for example, there's a 22, there's a 24, and there's a 29% bracket. So I'm just using some made-up tax percentages here. And basically you end up with $820 after taxes after you take into account the foreign tax credit. Okay. Now, I know what you're saying. Gosh, that's hard to know. I don't need you to know how to calculate a foreign tax credit and how to calculate what your net is and all that. But, when we're talking taxes, PowerPoints have a lot of text. Yeah, they do. There's just no way around it. Yep. So every now and then I'm going to try to interject great pictures for you that will hopefully liven things up. For example, like this one. Yep, that's a great picture. Oh, wait a minute. He looks like Barney, doesn't he? Yeah. My wife, she bought me this purple shirt, and every time I wear it to classes, I sometimes get mistaken for Barney. So, all right, let's go on to talk about tax deferred accounts. This is what most of your investments are going to be in for most people, because they're going to do most of their saving and investing inside a 401k account or some type of qualified retirement account or traditional IRA. There are all types of these accounts. There are 457 plans. There are the thrift savings plan for federal government employees. There's simple IRAs. There's SEP IRAs. There's all kinds of types of profit sharing plans out there. So we're just going to call them all tax deferred accounts. All right? And when you contribute to what's called a qualified tax deferred account, which most of these are, you're going to receive an income tax deduction. So you put $1,000 in, you get to reduce the amount that you report as income on your tax return by $1,000. That's great. But when it grows over time, and when you take the money out in retirement, which is typically age 59 and a half or later, then all of the distributions from that account are going to be taxed as ordinary income to you. So everything that comes out, you're going to get a tax deduction up front. It's going to grow tax deferred. You're going to pay tax at the back end. So, doesn't matter each year if there's interest income, dividend income, capital gain, you don't pay any taxes on that until you take the money out in retirement, and chances are you'll be in a lower tax bracket in retirement than you would be, for example, in your high earning years. All right. All the gains came out first, and all the gains are taxed as ordinary income, and there are no foreign tax credits or deductions. So if you have a tax deferred account that's investing in foreign stock or foreign bond funds, and they're paying taxes, you do not get a tax credit on your tax return for any of those that are held in tax deferred accounts, or, as we'll see, tax free accounts. Now, tax-free accounts, there are a lot of different ways of investing and not paying any tax. One is you can actually go out and buy tax-free municipal bonds, which we studied before. The problem is they pay a fairly low rate of interest, in fact, a lower interest rate than corporate bonds. You can also invest inside a life insurance policy. These are cash value policies that grow tax-free. The only problem is you got to die to get the tax-free treatment. Yeah. You also get a stepped-up basis. All capital gains on all of the property that you own, not tax-deferred accounts, but like, for example, you own individual stocks and individual, or your own real estate has gone up in value. All of those capital gains are eliminated. Only one problem: you got to die to get a stepped-up basis. And then you have Roth IRAs and Roth accounts within 401k. This is the best tax benefit you can ever imagine, because you don't have to die to get the benefit. You can get tax-free growth throughout your lifetime and start pulling money out in retirement tax-free. So Roth IRAs are fantastic. You have to have earned income to contribute to it. So, for example, let's say you've worked in college, you've made, we'll say, $10,000 this year. You can put up to the maximum, which is $6,000 here in 2020, into that account, into a Roth IRA account if you want. You can withdraw that, the tax-free growth, when you're 59 and a half or older, or you've met the 5-year holding period. But you can also withdraw, and I would only do this if it was an emergency. Let's say you put $6,000 in. 2 years goes by. The account's gone up to $10,000. You can pull that original $6,000 out at any time. So it's kind of like a cash reserve in essence. You can't pull out the gain without paying taxes and a penalty, unless you're 59 and a half older and you've met this 5-year period rule as well. So here's an example. How beneficial is this growing tax-free? Let's assume you put it in small cap value stocks, and over the long term, you earn 10.2% rate of return. If I apply something called the rule of 72 to this, I divide 72 divided by 10.2. Basically, I'm going to see that this doubles an investment every 7 years on average. So 6,000 becomes 12,000 7 years later. And I'll just extend this out to age 65. $6,000 becomes $396,000 tax-free. Wow. But you got to start early. You got to get the benefits of compounding. Now, you probably won't pull all the money out at 65. You'll probably let some of that continue and only pull out a portion, and you'll get some more tax-free growth. Roth IRAs are just incredible for this benefit of getting, basically supercharging your retirement in so many different ways. Again, you've got to start early. You've got to take advantage of the power of compounding. You've got to invest early. So let's assume you start at your new job. First day of work, you're very excited. Second day, new job, the MEMS have started. And then you survive the first week. Yes, you've done really well. All right. Now, let's say you're age 23, you're single, okay? You start a new job on June 1st, all right? You're going to earn $40,400 in 2019, so you're earning quite a bit. Because you started on June 1st, you got a really high salary. This is probably much more than most of you will get in your first year. You can take the standard deduction of $12,400. The result is that you possess taxable income of $30,000. All right. On taxable income, after taking the standard deduction basically means you don't pay any income tax for federal income tax purpose on the first $12,400. But above that, then with taxable income of $30,000, the first $9,875, you pay tax at the rate of 10%. The next, over that, from $9,876 up to $30,000, you pay 12% of that amount. So that 12% is what's called your marginal income tax bracket for federal tax purposes. Now, most states have an income tax. Some localities have an income tax. For example, a lot of cities and counties in Kentucky have a type of income tax based on your wage income in there. But let's just stick with the state income tax. Here in the state of Kentucky, there's a very small standard deduction, so I'm going to just ignore it and just say it's a flat tax rate of 5% for state income tax purposes. So here's the question. You got taxable income of $30,000. You're in a combined marginal income tax bracket, 12% for federal tax purposes. That's what you're paying on the extra dollar. 5% for state income tax purposes. So you got a 17% combined tax rate on that additional dollar of income. Your employer offers you a 401k with a match. For every dollar you put in, your employer will put in a dollar up to 3% of your pay. Should you participate? And what is the tax consequence to you? Yes, you should participate. Why? Your employer is giving you a buck for a buck. That's 100% rate of return, okay? Wow. In fact, you will have saved 6% of your pay just by putting in 3%. And you get to reduce your taxable income by the amount you put in. The amount your employer puts in, the employer gets a tax deduction for it. You don't. But you put in 3%, you'll reduce your taxable income. You apply your marginal combined tax rate that saves you $204 in combined federal and state income taxes. But you realize that you need to save a lot more. And you have a goal of saving 18% of your income. That means 18% of $40,400 is $7,200 you need to save. Yeah, that's a lot. All right, but you've already made $2,400. That extra $4,800 that you want to do, remember half of that $2,400 came from your employer. Should you put it in your 401k account or should you put it into a Roth IRA account? Yeah, you can put it into a Roth IRA if you want. And if you contribute, you're not going to get any tax deduction for that, but it grows income tax free. If you put more into your 401k account, you do get an income tax deduction for it, But you have to ask yourself, what is your tax bracket likely to be in retirement years? And because you're likely to have Social Security income and hopefully a lot more investment income at that point in time, your tax bracket is likely to be at least 20% in retirement, probably more like 25% for federal income tax purposes. I'm just speculating and looking ahead, plus whatever state income tax, unless you move to Florida where there's no state income tax, or Texas. All right. So in retirement, you're likely to be in a 25% marginal bracket because you're in a lower tax bracket now. All right, since your combined marginal tax bracket is less than 25%, it's usually better to do the Roth IRA contribution instead. Don't take the tax deduction for it, but get that tax free growth. So when you pull it out in retirement, you don't have to worry about paying taxes on that. Now, when you're saving for retirement, I just want to kind of touch base on this. Hopefully, your home will be paid for. My younger brother, 5 or 6 years younger than I am, just refinanced his home to take advantage of lower interest rates. He's actually done that 6 times since he bought his home. As interest rates go down, you get to refinance and save interest. And when he refinanced this time, he made sure that it was a 15-year mortgage because he plans to retire 15 years from now. We've also discussed, hey, your car, hopefully you'll have a car that will last at least 10 years. You shouldn't be replacing it every couple of years, even 5 years. But hopefully self-driving cars will come around and you'll basically lower even the cost of owning a car and for a lot of people. Retired households spend an average of $41,000 a year. That was 2016, the most recent year we have statistics for. And what do they spend that money on? Home maintenance, taxes, and insurance. Owning a home is expensive. There's a lot of things that have to be fixed every now and then. We get real estate taxes and homeowners insurance, food, transportation, health care cost. This is for people aged 65 or above. And that's health care with Medicare. So a lot of their expenses are paid for by the Medicare, which is a federal government program, and a little bit of clothing, charitable contributions, and the like. That's how the average person. I got to submit, though, that your desired spending level in retirement, you probably don't want to live on $41,000 a year in today's dollars. All right, you probably would like to live on 100,000 to 200,000 a year. That's going to allow you to live a much nicer lifestyle, to travel a lot, to spend a lot of time, spend a lot of money on grandchildren, things like that. All right. So you have to be tax savvy with your investments. It's not how much you make, it's how you keep it. So here's some rule of thumbs. Take advantage of your matching contribution from employers always. Right? Save 18%. Very start, full-time work, do that. All right, you got to do that. You got to set your that. Now you're going to get a tax deduction for some of that. All right, you're going to get maybe an employer match of 3 or 4%, maybe even higher. So you may not have to save 18% of your pay with that employer match plus any tax deduction you get. But try to have this mixture of tax deferred and tax free accounts to supercharge your portfolio returns. Now, here is the key to filling out a chart on where do you put stock mutual funds versus bond mutual funds, U.S. stock mutual funds versus foreign stock mutual funds. The first rule, and I tell you, this is something you ought to have on your index card for the exam, although we're not going to be using index cards this term for the final, but you need to have these rules written down. Hold foreign stock mutual funds in taxable accounts. That's the very first thing to do. Then you hold fixed income investments in your tax deferred accounts, like a traditional IRA or a traditional 401k or anything that says tax deferred on it. And the reason for that is bond and CDs have lower interest rates and they generate taxable interest, but that's not taxed until you pull the money out. All right. Then look for the asset class that's left that has the highest expected returns. Put that into the Roth 401k or Roth IRA account. About 70% of Roth 401k accounts have a Roth option where the employee part, the amount that you contribute to it, not the employer, but the amount you contribute can go into a Roth account. And that can supercharge your growth. Again, you don't get a tax deduction for the money you put into a Roth 401k account, just like you don't for a Roth IRA, but it grows income tax free. Then you want to hold tax efficient U.S. stock funds in taxable account. What's tax efficient? The stock funds with the lowest portfolio turnover. And that's usually large cap stocks, U.S. large company stocks. They usually have very low turnover. And then rebalance your portfolio and try to avoid short-term capital gains and harvest losses. But those first four things there basically become the rules. Now, we know that some asset classes are pretty inefficient, like high yield bonds generating a lot of interest, high turnover actively managed stock funds, and some are very efficient, like tax managed stock funds, and I would put exchange traded funds up here. Large company stock funds typically do a lot less trading. All right. So there are actually mutual funds out there that are designed to be tax efficient, tax managed. Sometimes they call them tax aware. They don't do a lot of trading, so they don't generate a lot of capital gains within the funds. They harvest losses to offset any realized gains that they do incur, and they try to make sure that most of the stocks that they hold, they get qualified dividend treatment by making sure they have it for the right holding period. And they'll loan out and get securities lending revenue, and um, some of them will do that. If they're highly diversified, they don't trade a lot. Index funds are usually more tax efficient than actively managed funds. This is just a chart back in 2013 that basically said that index funds have a lot lower tax impact than actively managed funds. And that's true to some degree, but it's not true for all indexes and all funds. And in fact, even if you compare the same index funds to each other, um, here's S&P 500 index funds. They all track the same index. You can see the 5-year returns are all the same, but the after-tax returns, the Vanguard one is a little bit higher. And the reason for that is Vanguard actually has a patent where it combines this fund with an exchange-traded fund, and it makes it more tax efficient. That patent is expiring, I think, this year or very soon. And as a result of that, hopefully some other funds will do the same thing. Exchange traded funds again can be more tax efficient than mutual funds because of something called authorized participants in the fund, where basically they can, if they need to raise cash in that fund to handle redemptions out of the fund, they can shed those stocks off to a brokerage firm, to an institutional investor who doesn't even have to pay tax. A lot of times, this is big pension funds, and basically it makes the fund very tax efficient for you. All right. If I were to search for tax efficient funds in different asset classes, well, a tax efficient U.S. large cap balanced fund. I actually find Vanguard large cap ETF. Fidelity didn't have any. Yeah. Dimensional has got a specific tax managed U.S. equity portfolio, and Vanguard's also got a tax managed capital appreciation fund. If I'm looking for large cap value, Vanguard does not have a fund that's specifically designed to be tax efficient. Dimensional does. Tax efficient small cap balance. Vanguard's got a small cap exchange traded fund that tends to be very tax efficient. It also has a tax managed small cap mutual fund. So a couple choices there. Dimensional's got, again, Fidelity's got none. And tax efficient small cap value. Uh, Vanguard's got a small cap value exchange traded fund. Because it's an exchange traded fund, it tends to be more tax efficient. But Dimensional's got a U.S. targeted value portfolio that tends to be very tax efficient. In the foreign markets, you see Vanguard's got basically an exchange traded fund in the developed markets. Dimensional's got actually a tax managed international value portfolio, so value tilt to it. This fund here does not have a value tilt to it. No tax efficient small cap funds are out there. And in the foreign emerging markets value, Vanguard's got an emerging markets fund, doesn't have a value tilt. Neither the other two companies do not. So, another type of fund is basically one fund. Let's say you want, instead of holding a whole bunch of different asset classes, you want to tilt the portfolio towards small cap and value stocks and profitability. What if you just own the entire market, but within the fund it does those tilts? So you have one fund. This is called the Tax Aware U.S. Core Equity 2 portfolio. All right. It uses strategies to delay and minimize the realization of net capital gains. It holds 2,676 securities last time I looked at this. That's basically owning most of the U.S. stock market. And what it does is it tilts the portfolio towards value, and it tilts it towards small. Small in value, actually, this is hard to see. This is the total stock market, but here you got a big tilt towards value. Here, both the large cap and the small cap space, and you've got more small cap stocks here than you would in a total stock market, just a fund that owns the entire U.S. stock market. So big tilts there. It's just another way of showing those tilts. Uh, Value, large cap value, more small cap, different way of showing that if you were to come across a chart like this. So let's try to put all this together into a different type of chart. So, and this is something you'll be working on. Here's a U.S. large cap stock fund, Vanguard Tax Managed Capital Appreciation Fund. It's got an expected annual return. It's got a portfolio turnover rate really low. That makes it very tax efficient. The lower the portfolio turnover rate, the more tax efficient it is likely to be. You put 10% of your entire portfolio in this account. Then you've got a stock fund using a profitability factor, 10% of your portfolio, 10% rate of return. You're going to put 15% of your portfolio in it. Mid cap value, 20%. International stocks, developed markets, 20%. International emerging, 15%, and 20% towards a bond fund. Now you got $500,000 total in your investment accounts. $100,000 of that is in a tax deferred account, a 401k account. $200,000 of that is in a Roth account. It's a tax free. Individual account is taxable. What do? You follow the methodology. Very first thing you looked at, foreign stock funds. Where do you want to put them? You want to put them in the individual account in order to get those foreign tax credits, because if they're in these other types of accounts, tax deferred or tax free, you don't get foreign tax credits. You have 20% of 500,000 or 100,000, so you put 100,000 here. 15% of 500,000 is 75,000. You put 75,000 there, and you put 175 there. The next step, where do you put your fixed income? You want to put all of your fixed income in your tax deferred account. So step number 2, put your fixed income investments there. You have 20%, just matches up very evenly with the amount that you've got in that account. Third step, you want to put in your Roth IRA the remaining assets, which has got the highest return. Highest expected return is mid-cap value in this case. So you put all of that there. Then you've got 15% of 75,000 in the next highest return fund. You put that there. And then that's really, after doing all that, all you're left with is 10% of 50,000, and you've got to split that between these other two accounts. So, kind of hard to do. Let's consider another one. This is more typical of a retiree. All right, we have similar asset classes, similar allocations, but this one's got 800,000 in a 401k account, a tax deferred account, 50,000 in a Roth IRA. A lot of people have not saved a lot of money in Roth IRAs, and 150,000 in taxable accounts. So most people, for most Americans, are going to put most of their money in these tax deferred accounts. How do we do the allocation? Well, the very first thing to do is, don't want to do that yet, is we want to fill up the taxable account with the foreign stock funds. Now, there's a couple different ways of doing this. We have 20% of a million, or 200,000 in developed markets. We have 150,000 here. In this case, I'm going to go ahead and put 150,000 in the taxable account here. All right. I could have put 100,000 here, 50,000 in emerging markets. Either way, all right. It not a huge difference in terms of the fact that you're going to get foreign tax credits. I know, and you do not need to know this for test purposes, but I would put more developed market stocks here for the reason that we have tax treaties with more countries in the developed markets than we do in the emerging markets. There's a slight difference there. So you tend to get a little bit more tax credits here. However, if you split that between the two, that'd be fine. The next step is, where do you put your fixed income? You got 20% of a million, 200,000. You want to put that all here. All right. Third step, where's the highest return asset class that's remaining? That's mid cap value. We've only got 50,000 we can put in there, so we put in 50,000, and then the rest we just have to fill up. All right, at that point, because we've already filled up this column, we've already filled up that column, means everything else has got to go there. So again, use that step-by-step approach when you're doing the homework, and we'll go over these charts more as we go through a couple more class preparation assignments. But in the meantime, have a great day. Thank you very much.